Here's the trick. The unchanged stance is the decoy. What if I told you the Fed's unchanged stance is the decoy, and the real move is happening in the quiet gaps between sentences? The real drama isn't on the slides. It's in the split between stage words and offstage numbers. The drama isn't in the dot plots or the headlines. It's in the split between what Powell says on stage and what the numbers whisper offstage. The dot plot is the Fed's chart of each policymaker's rate forecast. It hints at policy but never guarantees it. Start with Jackson Hole. Powell opened a door. At Jackson Hole on August 22nd, Powell said the Fed will proceed carefully and that the shifting balance of risks may warrant adjusting our policy stance. Plain English. Small cuts are on the table if jobs soften while inflation keeps easing. Rewind with me. That hold came with a tell. Last month, Powell held rates at 4.25 to 4.50%, called risks two-sided, and almost under his breath flagged rising risks on both inflation and unemployment. Two governors even voted to cut on the spot. That's not noise. That's choreography. A dissent is a governor voting against the majority. It's a flare, not a footnote. Jackson Hole made the subtext explicit. Risk management now leans toward employment, not just prices. On the surface, it sounded cautious, but underneath, it was a contradiction. Cleveland Fed's new tenant rent data, basically the going rate on fresh leases, shows shelter inflation far softer than the official line admits. In plain English, disinflation is landing while the Fed keeps talking tough. Disinflation equals inflation is still rising, just at a slower pace. Powell acknowledged that progress, while stressing any move, would be paced and data-led. And labor, it's losing altitude. Job openings slid to about 7.4 million. Continuing claims, people still drawing unemployment checks, are up near 2 million, the highest since late 2021. And the Conference Board's jobs are hard to get. Reading has climbed 7 months straight. That's not overheating. That's cooling. JOLTS openings equals the Fed's dashboard for hiring appetite. When that drops, recession odds rise. Powell called the job market a curious balance that could tip fast. Another tell that the cut debate is now about jobs risk. Business investment just hit the brakes. That's the jolt. Earlier this year, business spending was sprinting in double digits. Last quarter, barely 2%. Yes, GDP flashed 3%, but that was juiced by trade swings. Take out those one-off boosts and what's left? Real private demand, barely cleared 1%. That's the kind of slowdown that usually shows up right before recessions. Jackson Hole put it in plain terms. High borrowing costs are already biting into business spending, and Powell hinted that if that drag keeps spreading, the Fed wants the option to trim. And those dissents? They weren't noise. They were stagecraft. Two governors wanted to cut now. Powell brushed it off, but the statement softened into attentive to risks on both sides. That's rehearsing a pivot without announcing one. You don't record a dissent unless you want Wall Street to pre-digest the turn. Jackson Hole kept that tone. Careful, conditional, and labor-aware, letting markets move first. Zoom to now, the market's already leaning. As of mid-August, traders are leaning hard toward a September 17th cut. A quarter-point trim is now the base case, especially after the latest wobble in jobs. Powell may sound cautious at the mic, but markets are already pricing in easier money. And if you want the cleanest tell, keep your eye on the 2-year Treasury. It's always the first place to sniff out a Fed pivot. After Jackson Hole, major desks, Barclays, BNP, flipped to a September cut and markets price cut odds in the high 80s. Let's clear the fog on inflation. July's headline cooled to 2.7%. Core sat just over 3%. Hotels fell. Airfares bounced after months of decline. But step back, real-time trackers like Trueflation already put inflation near 2%. Services are easing, goods ticking up, but broad pressure is softening, right as jobs wobble. Headline equals all prices. Core equals strips out food and energy to see the underlying pulse. Powell also downplayed tariff bumps as short-lived. Another nudge that a cautious cut isn't off-brand. So why hold steady? Because three plates are spinning: credibility, household cash, and yes, politics. Credibility first. After the transitory miss in 2021 and the autopilot stumble in 2018, Powell can't look reactive. Higher for longer became the brand. Flip too fast and you torch the brand. Cash next. The oxygen of markets is sloshing in buckets. Households have $7 trillion sitting in money market funds, raking in fat yields. Cut too soon and that cash stampedes into risk assets. Cut too late and savers get punished. Timing beats level. Liquidity equals cash flow, the oxygen of markets. Two dissenters with clout want cuts. Powell can't look like he's bending to rivals or headlines. He wants a mosaic, multiple signals, so the brand survives the turn. Markets can smell the contradiction. Growth softens, prices cool, but the Fed sits tight. That's buying time while the cycle erodes. Credit spreads widen, delinquencies creep up, mortgages tighten, builders dangle incentives, sponsor-backed defaults climb. A credit spread equals the extra yield over treasuries. Widening equals stress building. Here's the trap. Investors lean on the wrong dashboard. Lagging inflation looks calm just as the road ices over. Charts look fine, volatility bleeds lower, breadth narrows. Then revisions hit, hiring buckles, and everyone finds the brakes together. Breadth narrows. Fewer stocks are carrying the rally. History has already scribbled this lesson. In 1937, the Fed pulled support too soon and the economy relapsed. In 1994, hikes torched bondholders. In 2013, one word, taper, sent global markets reeling. In 2018, Powell's balance sheet line sparked a December meltdown. Different years, same note in red ink. Communication is policy. Move too slow and the soft landing stalls. Move too fast and you spook the cash base underwriting equities, threading a needle in a crosswind. Powell's Jackson Hole message, thread it carefully, only with fresh confirmation. Housing is the hinge. A token cut doesn't fix affordability. Mortgage math still bites. Hold longer and prices reset lower. Good for first-timers, tough on owners, lenders, and tax bases. Dash back to zero or revive massive bond buying and housing ignites again. Powell's goal, let the air out slowly, not blow the tire. QE, quantitative easing, is bulk bond buying. It juices mortgages, but it risks bubbles. And inside the Fed, it's as much about managing the room as the economy. One bad forecast, one sloppy model, and lawsuits line up. That's why the wording softened while the rate held. Consensus inside matters as much as steering outside. So what actually flips the switch? Not one report. A pattern. Softer rents, cooler wage growth, jobs hard to get climbing, defaults edging up, weak final demand 2 months in a row. That mosaic gives Powell cover to cut. Jackson Hole set the test. If inflation progress holds while labor wobbles, a timely trim is in play. Done right, a modest trim, data dependence, vigilance on jobs. That path supports risk without torching savers. A narrow bridge, but it holds. Done sloppy, cut late into labor weakness or slash into steady prices. You either invite a growth scare or shake the savers propping this rally. Both end messier than they should. If this kind of straight talk keeps you a step ahead, hit subscribe and ring the bell. Rule books bend. The edge goes to those reading the margins, not the marquee. History rhymes, power rebrands. Stay inquisitive.